Welcome to Money and Markets, Series 1, Lesson 8. This episode is called When Borrowers Break. In Lesson 7, you learned that longer loans carry higher rates. Part of the reason is uncertainty. Part is the risk that the borrower might not pay. Now we face that risk directly. What happens when a borrower fails to make a payment? What happens when they cannot pay at all? The answer has a name: default. Default is one of the oldest concepts in finance. Predates spreadsheets, central banks, and stock exchanges. The word bankruptcy itself comes from the Italian Banca Rotta, which means broken bench. When a medieval trader or dealer could not meet his obligations, his bench in the marketplace was literally broken in the public square. A visible, humiliating signal that this person could no longer be trusted. This lesson walks through what default means, how lenders try to prevent it, and why it matters for every interest rate you have seen so far. Let us start with the definition. Default means failing to meet a financial obligation as agreed. The most common form is a missed payment. You owe money on a specific date and you do not pay. But default is not always dramatic. Can start quietly. First comes a late payment. You miss the due date by a few days. The lender notices, but may not act immediately. Then comes the grace period. Many loan contracts give you a window, often 15 to 30 days, to make the payment before official consequences begin. If you still do not pay after the grace period, the lender reports the delinquency. Your credit record takes a hit. Late fees accumulate. Interest may compound on the missed amount. And if you continue not paying, the situation escalates. The lender may declare the full loan in default. At that point, legal remedies begin. The lender can demand immediate repayment of the entire balance, seize collateral, or begin court proceedings. That escalation ladder, from late payment to grace period to delinquency to default, is the timeline every borrower should understand before signing a loan. Now the safeguards. Lenders do not just hope borrowers will pay. They build protection into the contract. The first layer is collateral. If you borrow to buy a house, the house itself is the collateral. If you stop paying, the lender can seize the property and sell it to recover some or all of the loan. Secured loans, loans backed by collateral, carry lower rates than unsecured loans. That is because the lender's loss is cushioned by the asset. The second layer is covenants. These are conditions written into the loan agreement that restrict what the borrower can do. A company might agree to maintain a minimum cash balance or limit how much additional debt it takes on. If the borrower violates a covenant, the lender can demand early repayment or renegotiate terms. Covenants act as early warning systems. They force the borrower to stay within boundaries that reduce the chance of default. The third layer is credit assessment. Before lending, the bank evaluates your ability to repay. Income, employment history, existing debts, credit score. All of these feed into the decision to lend and at what rate. Bankruptcy is the legal end of the default road. The word itself, as we mentioned, comes from the Italian Banca Rotta, broken bench. When a medieval lender in Florence or Venice could no longer honor his debts, his bench in the market was physically smashed. A public signal that this person could no longer be trusted to trade. Modern bankruptcy is more structured, but the core idea is the same. The borrower cannot pay, and a legal process begins to sort out what happens next. In most systems, there are two paths. The first is liquidation. The borrower's assets are sold, and the proceeds are distributed to creditors in a specific order of priority. Secured lenders get paid first from the collateral they hold. Unsecured lenders get what is left, which is often very little. The second is reorganization. The borrower proposes a plan to restructure debts, reduce payments, and continue operating. This is common for companies. It gives the business a chance to survive while creditors accept modified terms. Neither path makes lenders whole. Default always destroys value somewhere in the chain. Now connect default back to interest rates. Every interest rate you have seen in this series contains a component that compensates the lender for the risk of not being repaid. In Lesson 4, you learned about the risk-free rate, the spot rate on a government bond where default is assumed to be negligible. In Lesson 6, you saw that the bank spread includes a provision for expected losses from default. The difference between a risk-free rate and the rate on a corporate or consumer loan is called the credit spread. It is the premium the lender charges specifically for bearing default risk. Higher default probability means a wider credit spread. That is why a borrower with a perfect credit score pays a lower mortgage rate than a borrower with a history of late payments. Same house, same maturity, different risk. And that is why a credit card, which is completely unsecured, charges 18% while a mortgage backed by a house charges 7 or 8. The collateral reduces the lender's loss if default happens. No collateral means the lender absorbs the full loss. Default does not happen in isolation. It ripples. When one borrower defaults, the lender absorbs a loss. If many borrowers default at the same time, usually during a recession, the lender itself can become distressed. This is the connection to Lesson 6. Banks fund themselves with deposits and lend to borrowers. If enough borrowers default, the bank's losses can exceed its capital cushion. And if the bank fails, depositors may lose access to their money, unless deposit insurance like FDIC protection exists. That chain, from individual default to institutional stress to systemic risk, is why regulators care so much about credit standards and capital requirements. It is also why the Herstatt story matters. In Lesson 15, we will tell the story of a bank that failed in 1974 and how that failure led to the creation of the Basel Committee on Banking Supervision. Every modern bank regulation traces back to moments when defaults cascaded through the system. For now, the takeaway is simpler. Default is not just a borrower problem. It is a system problem. How do you measure default risk? At the simplest level, credit scores and credit ratings. For individuals, credit bureaus assign a score based on your payment history, debt levels, length of credit history, and types of credit used. A higher score means lower perceived risk. A lower score means the lender charges more or refuses to lend. For companies, credit rating agencies like Standard & Poor's, Moody's, and Fitch assign letter grades. AAA means the company is extremely unlikely to default. Below investment grade, sometimes called junk, means the risk is significant. These ratings are not predictions. They are assessments based on available information. Companies with excellent ratings have defaulted. Companies with poor ratings have survived for decades. But ratings serve a practical purpose. They give a common language for pricing risk. When a bond is rated BB, every market participant knows roughly what default probability that implies. And they can compare it to the credit spread to decide whether the compensation is fair for the risk. Two numbers every credit analysis starts with. First, probability of default. This is the likelihood that the borrower will fail to pay within a given time horizon, usually expressed as a percentage per year. A AAA-rated company might have a probability of default below 0.1%. A single B-rated company might be above 5%. Second, loss given default. If the borrower does default, how much does the lender actually lose? A mortgage lender might recover 60 or 70% by selling the house. A credit card lender might recover almost nothing. The expected loss is the product of both. Probability of default times loss given default times the exposure. This is not advanced mathematics. It is multiplication, but it is the foundation of every credit pricing model in finance. The credit spread on any loan or bond is set to at least cover the expected loss, with an additional margin for uncertainty. You do not need to run these models today, but knowing the vocabulary default probability, loss given default, expected loss, gives you the building blocks for everything that follows in the credit risk part of this series. What can you do as a borrower to reduce your default risk? 3 practical habits. First, borrow within your means. If the monthly payment stretches your budget to the limit, any disruption, a job loss, a medical expense, a rate reset, could push you into default. Build a margin of safety. Second, understand the contract. Know the grace period. Know the penalty structure. Know whether the rate is fixed or variable and what triggers a reset. Lessons 5 and 7 gave you the vocabulary for this. Third, protect your credit score. Pay on time. Keep utilization low. Do not open accounts you do not need. Your credit score is the summary statistic that determines what rate you pay on every future loan. These are not finance tricks. They are basic contract literacy. The same concepts apply whether you are managing a household mortgage or evaluating a corporate bond in a portfolio. Default risk is the thread that connects everything we have built in Series 1. Time value, compounding, inflation, rates, spreads, maturity, and now the possibility that the money does not come back. 3 takeaways to carry forward from this lesson. 1. Default means failing to pay as agreed. The escalation path runs from late payment to grace period to delinquency to full default to potential bankruptcy. Collateral, covenants, and credit assessment are the lender's defenses. 2. The credit spread is the premium lenders charge for default risk. It is built from probability of default times loss given default. Higher risk means wider spreads, which means higher rates for the borrower. 3. Default ripples. One borrower's failure becomes the lender's loss. Many defaults become systemic stress. That chain is why regulation, deposit insurance, and capital requirements exist. Next lesson, we put it all together. Retirement by the numbers. We take the time value of money, compounding, and real rates and solve a practical problem. How much do you need to save each year to retire with $1 million in today's money? I will see you in Lesson 9.